Well, here we go. It's been a busy day at work, but I'm going to get this video done for you guys, and we've got a lot to talk about today. There's a lot of subjects, so for you guys that enjoy it where I cram like a lot of subjects in one video and spend a minute or two on them, this video is for you. We're going to talk about the new inflation data that has come out. We're going to talk about InMode and the big share buyback they've just announced. We're going to talk about gaming realms after reported earnings, and then we're going to talk about potentially a new number one position in the whole portfolio. This will be my biggest position in the stock market, above HIMS, above DraftKings. This could be a number one biggest holding that I have, brand new. It's a stock that I currently do own, but I'm thinking about maybe increasing the position size, and to get it to my number one holding, I would have to probably increase the position size by probably over double. So there would be a fair bit of buying going on. So we'll talk about that today. So I hope you enjoyed the video. Hit the like button. We're closing on 16,000 subscribers. Thank you for the support recently. The views have been absolutely amazing. The subscribers that have been coming in has been amazing. And yeah, we're very close to 16,000 subscribers. So if you're new around here, subscribe. If you watch the videos for a long time and you've never subscribed, make sure you subscribe. If you do get me there, I'll do a live Q&A session for you guys on the main channel on a Sunday whenever we do get there this month. Apart from that, let's get started on today's video. So first of all, let's start with the inflation data. I'll keep this basic because it seems like we cover it nearly every time it comes out and there's not really much change, but overall the inflation data was good. The expectations was a 2.6, the trading economic forecast was 2.7. It came in at 2.5, so very impressive once again. A big drop off from the last month, and this lovely downtrend that we've had since March time continues in the inflation data, which is really good. I think realistically now, the Fed's target is 2%. We're at 2.5%. We're basically there. It's very hard for them to get always that bang on that 2% target. The fact that we are now at these sort of levels and we haven't seen a cut yet is just beyond me. It took, what was it at, like 6% for the Fed to start putting up interest rates. I mean, if they're going to be waiting for 2% to start actually cutting interest rates, that's absolutely insane. But if anything, I mean, this must be confirmation that we are going to get a cut in September. What surprised me today is the market didn't really react that positively off it. My thinking is there's maybe some sort of play on the presidential debate that happened last night, and I think maybe there was a swing that I think Trump maybe didn't perform as strong as people was expecting, and I think the stock market is kind of pricing in a bit of a Trump win at the moment. Maybe that's what's causing the toll in the market, because the inflation data was positive, the downtrend continued, and when you dig into the numbers as well, I mean, if anything, it wasn't positive, it was actually negative how much this inflation data is dropping, because you looked at the numbers, I mean, there was just so many negative numbers in the inflation report, or 0 point something, like getting towards deflation numbers, that it was actually a little bit concerning. I mean, the other thing is like shelter still continues to be like a major drag on the inflation, which is a lagging indicator. I think they even closed up at the top that said the index for shelter rose 0.5% in August and was the main factor in all items increase. So we still have the lagging indicator that is shelter still pulling up inflation. If it wasn't for that, everything's relatively really good at the moment, and the Fed should have been considering it. The other thing that I would say is like the amount of negativity that was in here, like apparel, for example. Apparel was quite weak. Used cars and truck prices, it shows you that the economy is slowing down. People aren't going out and spending on those new cars and new vehicles or a used one. The other thing is like energy. Energy was down massive, and you look at what is going on with the energy prices at the moment. They had an even bigger drop during August into September. So if this is the data that's coming out from August at the moment, imagine when we get this batch of data and you look at WTI crude, for example, it's sitting around $67. It's going to be very low, is in my opinion, is the inflation data that we get for September. I think you could argue the case that we could be near the 2% range. And what is the leading cause of inflation? What causes inflation most of the time, and even what caused inflation this time round? What was the cause where inflation went absolutely bonkers during 2022, when it was the whole Russia-Ukraine, oil prices going absolutely crazy? And when you look at oil prices at the moment, they've basically really started to recover that dip that we had in, or the jump we had in 2022. And if anything, we're heading to pre-CV prices, and if that is the case, inflation is definitely going to be looking very close to that 2% target, or even below that 2% target. So yeah, good inflation data, but I don't know what use it is, because even though this inflation data has been good for the last kind of 3-4 months now, the Fed have sat there and not cut interest rates, which is just absolute insanity, and is causing a lot of weakness out there. And we can even see it in these numbers, that the reason why some of these numbers are starting to go, big negative or flat numbers, is because things are slowing down out there. People are having to lower prices to be price competitive, and that's the sign of a recession. Get on some individual stocks anyway. InMode is having a good week. It's about time, because it's been a really tough time for InMode at the moment, but they did announce a share buyback. They said they're going to buy around about 7.68 million shares, which at the moment is around about 84 million shares they have. Lazy maths would say it's just less than 10% of the current market cap. So yeah, InMode are going to be buying back about 10% of the company shares, which is obviously really good, because less shares outstanding obviously makes the stock look a lot better. You as a shareholder own more of the business if there's less shares outstanding, and obviously from an EPS point of view, that would also improve the EPS. So if the EPS is going to drop, all of a sudden with the share buyback, it's going to neutralize it. So this PE ratio that we do have of like 9 times earnings, for example, or 8 times earnings, looks more attractive if the stock ever does kind of bounce back. And that's a big thing with InMode. It's been a tough time at the moment. You look at the recent financials for InMode, they've been pretty poor. There's no way to get around it. The recent numbers have been pretty poor, as you can see down here. But what it does do is, with all these share buybacks, which is funny because the management said we're never going to do a share buyback, and now they've done 2 share buybacks, which I don't know where the change has kind of come from. I don't know if it's just constant pressure from shareholders and the board to do share buybacks, but this is really good, because if they ever do go back to any amounts of growth now at like 8 times earnings, 9 times earnings, if this company ever gets back to like 3-4% revenue growth, this company's going to do really well. Never mind if it gets back up to like 10% or plus revenue growth. If it gets to them sort of levels, you're going to kind of be wishing that you bought like at $17. And maybe it's a master plan that the members of the board have suddenly decided they're going to do a share buyback now. Maybe they've got it right at the bottom. But yeah, it's very strange how it's only just started now, but at least they're doing it. And if you look at this year at the moment, 13% negative growth. But like if you look at analysts here, analysts are expecting like 6% growth next year. I mean, we'll have a better idea towards the end of the year what InMode could potentially do. And even next quarter, if that's true, obviously that will be very, very good. If they get any signs close to this, yeah, it's going to be interesting. So I'm all eyes on this one now, because if any signs that these lower interest rates start coming in and the stock starts flying, I'm going to be buying this one big time. So we'll keep an eye on that one. Gaming Realms, quick mention on Gaming Realms. I posted on Twitter, which you can follow me, JKR, I think it's JKR Investing on there. I posted on Twitter about Gaming Realms, and I was just laughing to myself because the stock was negative today, and the company brought out their interim results, and they were like fantastic. I really expected. I read the interim results at like probably 7 o'clock when they came out, 7 a.m. And I thought, wow, that's great. Like the stock's probably going to be up over 10% today. And then I looked at probably 8:30 before I started work, and I looked at the stock price and it was down like 6%. And I was like, what? How is the stock down today 6% when they've brought out these results? Revenue was up 18%, adjusted EBITDA was up 21%, profit before tax was up 51%, the cash balance was up like 23%. It says somewhere down here. Oh, it's even better. It was up 28%. I was looking at this thinking, how has the company gone? How is the stock market valuing this stock less than what it did yesterday, when it's now brought out update financials and the financials have got stronger? And then they've not even got stronger by like a couple of percent. Like 18% growth is insane. Adjusted EBITDA up 21% is crazy. Profit before tax was up 51%. Like this is no small increases. This is fantastic numbers, and yet the stock market's going to value it 6% less than what it did yesterday. Give me a break. I mean, it's one of those where you start banging your head on the table. Like sometimes that's what the stock market can do to you. Like it sometimes doesn't make sense. And at the moment, like if this continues, I personally earlier today worked it out was around about 13 times forward earnings. But Gaming Realms, I guess actually saying that I did it from the full year results, which would actually be in around about 6 months time. So I guess if you actually went 12 months ahead, it could actually be 10 times earnings, thinking about it. I worked it out as 13 times forward earnings, but clearly here, Guru Focus is working out at 10 times forward earnings. You should not be picking, if it's either 10 or 13, the point stands that you should not be picking a company up that's growing 18% on a profit before tax basis, up 51%. You should not be picking those sort of businesses up at 10 times, 13 times forward earnings. Like, this is a company that should be trading at, this is a premium UK company. Like, we don't have many good growth companies like this on the UK side. And it's got a cracking balance sheet as well. Like, a company like this should be at least the market average valuation of 20 times earnings. I think it should be a premium, like 25 times earnings. Maybe you could argue the case for 30 times earnings. But even if you take a market average of like 20 times earnings, I mean, it should be at least 20 times earnings. And, you know, what we're sitting at is, I mean, it's 18 times at the moment. But very quickly, you know, if we start looking at the updated numbers, it's, yeah, I could argue the case in the next kind of, when they pull out the full accounts in April, I'm going to argue the case that this stock should be probably double where it is right now. So, yeah, I mean, I think I kind of gave you a hint what I did today after this report, but that's the stock market, guys. There's been many times before where I've seen fantastic reports come out and the share price is just like, that's when the stock market does kind of get annoying when that happens, but if they consistently do it, hopefully it starts reflecting on the share price. And the last stock that I'm going to talk about today is Google. So yeah, this is the stock that I'm actually, the video is actually called about, which is my potential new number one stock, and that is Google. So I actually wanted to make Google my largest position back in 2022 when we had the worst stock market crash since 2008. I bought a lot of the stock in that time frame, and I am up quite a bit on the position that I did buy. However, I never really bought enough. I got it up to about my 5th largest position, but I wanted to make Google my largest position, and I was never able to do it because it just didn't stay in this range long enough. And then it rallied up and we were up a lot. I took a bit of profit off the table, and now it's having a bit of a pullback. So I'm not only looking at the profit that I've took off the table, which a few people always say, like, you know, why sell it? And, you know, just for this case, you know, out of nowhere, you know, Google starts dropping. You know, starts having, I mean, you could nearly officially say Google is actually having a crash at the moment because the stock has actually fallen over 20%, which is an official crash. You know, you start looking at a crash here and you think, I'm glad I kind of took a profit off the table. But now I'm looking and thinking that 20% crash has actually put it back to attractive valuations at the moment. You know, you're also getting a little bit of a dividend here and now with this one, but 21 times earnings for a company like Google, like, would you probably say Google is the best company in the world? I'd definitely argue the case it's probably top 5 best company in the world. You know, you're probably getting a top 5 best company in the world at the moment at 21 times earnings. This is when you've got like the current market for the S&P is like 29 times earnings. I mean, that is, you know, so attractive. And the point of view as well is like, you know, the company's really buying, you know, doing the share buybacks, the profitability is ramping up from like all the job layoffs they've been doing. It's actually around about 17 forward times earnings at the moment. To kind of put that into context, like, the lowest that Google's ever traded at is, in the last 10 years, is 17 times earnings. Now, obviously, that's forward earnings, so it's not there yet, but give it another, you know, couple of months when they do the next bits of numbers, you're going to be at nearly 17 times earnings. I mean, it could go a little bit lower to that historical valuation, but it's kind of getting there. And the consideration as well is like Google normally trades at 28 times earnings. I think that's a pretty fair valuation for Google. I think it should trade more than 20 times earnings. It's one of the best companies in the world. I don't know what the premium you throw on the business is, but I think that's probably around about fair, and it's definitely nowhere near what it normally trades at and what it probably should trade at, and that's very attractive for me because I love Google. You know, the last numbers I thought were fantastic. You know, good beat on the EPS, revenue growth of 13.6%. This is, you know, very good amounts of growth. You know, doing the buybacks, the dividends. You got so many growth drivers here. You know, you're getting the Google search, you're getting the Google Cloud, which is really ramping up profitability. Waymo potentially you could throw in there. YouTube. It's a fantastic business, and I think the stock there's a few reasons why maybe the stock is dipping at the moment. A few people are throwing a few things out. I think more than likely the concerns are probably on the report that the DOJ might be breaking up Alphabet. at the end of the day, I don't even think that's a bad thing. I think if anything, that might be a good thing, because if they are broken up, unless they're forced to sell something off, which I don't think it will be, I think they'll just have to be separate businesses. You know, if they're separate businesses and then they go put them on the stock market, imagine if you're able to go buy Google Cloud individually, or you go buy Google Search individually, or YouTube individually. As an individual businesses, you might actually get them for more value than they are actually worth together. And the thing as well is, like, some of these things here, I mean, there was another court case, I hadn't even loaded it up, but there was another one with Europe. They got fined the other day. I haven't even loaded it up, but there's I can actually, I'll talk to you and I'll type. I apologize, because when I multitask, I am like a typical bloke. I am so slow at it. But they got a fine off Europe the other day, and the fine that they got was quite a hefty fine. Oh yeah, here you can see. Yeah, it was quite a big fine. But the thing is like, this is something that's like come from like 2017 or something like that. That's how long these things take to happen. So it's not something that will happen that fast. And you know, you look at the business and it's just going to continue ramping up with the revenue, the profitability. Balance sheet wise, it's probably the best balance sheet, I would say, on the stock market. You know, there's 3.9% debt on there. The cash has gone down a little bit at the moment with the dividends, the share buybacks, and investments into AI that they're doing, which once again might be a major growth driver for them in the next few years. It's probably one of the best balance sheets, if not the best balance sheet from a public company out there. You know, they're sitting on 100 billion of cash. You know, imagine the amount of companies they can go buy there. And every year they're only going to be throwing another 95 billion of cash on that balance sheet. Yeah, it's insane, isn't it? You know, they can afford to buy nearly every single public company every year with that profitability and balance sheet. So yeah, I think Google's a fantastic business. In my opinion, it's probably the best company in the world. It's up there between the likes of Microsoft and probably Meta and Amazon, probably between those businesses. But yet this is the one at the most attractive value, and it's I wanted to buy more during this period of time. I never was, sorry, not that period of time, that's the wrong chat. I wanted to buy more during this period of time. I got some shares, but I wanted to make it my largest position. Now I feel like this 20% drop here. And yeah, it's maybe not as low as when it was during this period of time. But the thing is, you look at the profitability from the likes of 2023 to where it is, you know, right now. You know, the profitability and the revenue has ramped up since that time frame. So you can argue the case that, yeah, maybe it's not at them sort of share prices, but during that time frame, I mean, the business was doing 70 billion in profitability. The company's now doing 87 billion in profitability, and with the shares they're buying back, it's nearly the equivalent valuation of where I was buying it last time. So yeah, I wanted Google to be my largest position. I tried. I didn't have enough time to build it up to my largest position. I feel like I might have a second opportunity here now, and I would not mind Google taking over the number one spot, and I might start planning on doing that in the next coming 6-12 months if I can, to get it there this time. So watch this space is what I'll say on Google. Anyway, hope you enjoyed the video. Let me know what you think about Google in the comment section, guys. Hope you enjoyed the video. Talk about quite a few subjects there. Remember, if you're not subscribed, make sure you subscribe, guys, and have a great evening. See you in a bit.